Hey guys, in this video we're talking about the relationship between interest rates and asset prices. This is such an important concept for economics majors and finance majors. And guys, just people who kind of like watch the market, like the stock market, they probably want to understand this type of thing. Here's the idea, guys. The Fed comes out and says something that indicates maybe a slight interest rate change, and then immediately the stock market reacts, goes up or down. Hey, why is that happening? Well, this video is going to explain that. Now, in this video, we've got two guiding lights. They are quotes from Warren Buffett. Here's the first one. Everything in valuation gets back to interest rates. Everything in valuation gets back to interest rates. He's saying when he evaluates the value of any wealth asset, stocks, bonds, real estate, at the core of that evaluation is interest rates, okay? It's important for the valuation of any of those wealth assets. He's also said interest rates are like gravity when it comes to asset prices. Again, he's not just saying interest rates affect bond prices, he's saying interest rates affect asset prices. And this analogy right here, I think, is kind of fun to play out, kind of gets us to our overall answer about this relationship. Doesn't give us all the explanation, but gets us to the answer. It goes like this, guys. If interest rates go down, if they shrink, that means their gravitational pull is weakening. Guess what? Asset prices are going to go higher, right? So interest rates go down, asset prices go up. Or if interest rates go up, their gravitational pull is strengthening, asset prices are going to come down. Again, that's just playing out the analogy. It doesn't give us all the understanding that we want. To get our understanding, we've got to get through his, okay? Or get through this kind of little list here, okay? So let's get to it. The first thing is I want people to understand return is different than rate of return. When you hear somebody talk about return, they should be, or generally they are, talking about the dollar amount, the dollar return of an asset, okay? The income return, the income payment an asset is going to provide in dollar terms. So again, return, that's the dollar amount an asset is going to return. Rate of return is the percentage return, okay? So it's the percent return an asset's going to provide. And of course, the percentage return looks at, yes, the dollar amount return, but also looks at the asset price, right? If the asset price goes up and the return stays the same, the rate of return of the asset is going down. If the asset price goes down and the return, the dollar amount it provides, stays the same, the rate of return is going up. So return, dollar amount, rate of return, that's percentage. And when we talk about percentage, a percent of the asset price. Next, price or value. Guys, price and value is basically the same thing. When you hear stock analysts saying, valuations are high, they're saying stock prices are high. So price and value goes together. Now, what's the relationship between the price of an asset and the rate of return? Well, we kind of just talked about it right there, guys. If the price goes up and the return doesn't change, guess what? The rate of return is going down. And if the price of an asset goes down and the return, again, doesn't change, guess what? That means the rate of return is going up, okay? So there's this relationship between price and rate of return of an asset. I've also written yield here. I'm going to use, I might use that term yield. Well, it just means rate of return. It's just the percent return. Understanding that there is actually a slight difference, but it's not so important for this video. Yield is just looking at the percent return of an asset when it comes to their income payments like interest, dividends, or rents, depending on what asset we're talking about. Rate of return does look at those income flows, again, interest, dividend, and rents, but rate of return is a little bit bigger concept in that it also takes into account capital gains or capital losses, okay? So this one also takes into account capital gains, capital losses, yields don't, but that's not so important for this video, okay? They're both basically looking at the percent return of an asset, okay? Moving on, general equilibrium. This concept is a really important concept in economics, and it's going to play out in this video. But first, I'm going to say kind of how it's used in economics. Oftentimes, it's usually used in terms of a goods market, okay? And the idea is if we get some shock to a specific goods market, okay, it ripples out into related goods markets, things that are substitutes or complements or inputs to production or whatever. It funnels out into other markets and impacts other markets. For an example, just quickly on this general equilibrium, if we put a tariff on EV vehicles, right? Electronic vehicles, a tariff meaning on international EVs, well, it would affect the international EV market, but then it would affect the domestic EV market, right? Now it's rippling out, and then it would affect the gas-powered car market, both international and domestic, right? And so you would see not just price changes, supply and demand changes, i.e. price changes in the foreign EV, it would ripple out into these other markets. This is the concept of general equilibrium. You change something in a specific market, guys, it's going to ripple out and have an effect in other markets, and you have to look at how it's going to affect all these other markets to get a new general equilibrium. Well, where's that going to play out today in regards to our wealth assets, okay? Understand there's more wealth assets than these three things, but these are kind of like the three big ones, so we're just going to go with those just because we're just doing concept here. Bonds, stocks, and real estate, okay? If a change happens to any of the returns of any of these assets, it's going to ripple to the other ones, right? They're all related. They're substitutes to each other. I mean, think about it, right? You get your income, you want to put some into investment, and you allocate your income into these different buckets. In fact, we could get more complex and say, really, there's all kinds of different bonds, different risk associated with different bonds, different maturities. There's different stocks, whether it's income or growth or small cap, large cap, all that kind of stuff, mid cap, right? There's different types of real estate, commercial, residential, and all kinds of gradients of that. So we could really dive into this and see all kinds of related markets inside of there, all kinds of related markets inside of there, and all kinds of related markets inside of there. And again, you change just one market in one of these, it ripples through the rest of them. And then when that changes, it ripples through here and ripples through here. The concept of general equilibrium. And guys, it is relating back to this, okay? That's where we're going here. I just want you to understand this. Oh, okay, if I make a change in one market, it's going to ripple through these related goods, especially ones that are substitutes for each other. Now, let's get to where we want to be, which is interest rates and asset prices, okay? So, I'm going to get in the weeds just a little bit here. The Fed changes interest rates. The way they change interest rates is they control some specific interest rates. Here's one they absolutely control. They administer. They can just set. It is the interest on reserve balances. Interest on reserve balances. It's the interest they pay on commercial bank cash balances held at the Fed. I know, a mouthful. But here's the thing, guys. Banks hold cash reserves, hold cash at the Fed, okay? And the Fed pays interest on those. And the amount of interest they pay is determined by the IORB, the interest on reserve balances. Again, something they directly change. Now, let's think about a bank, okay? They have allocated their cash, right? Their assets, if you will, to all kinds of areas. They have some cash balances at the Fed. They've also lent money to other banks in what's known as a federal funds market. They've put money into money markets. Now we're about to get a little bit more real. They've lent money for home buying. They've lent money for car buying. They've lent money to small and middle-sized businesses. They've bought bonds, short-term and long-term bonds, right? They have their own asset allocation. A bank has its own asset allocation. So when the Fed comes in and changes the return cash gets when held at the Fed, well, guess what? That is a change in the rate of return of that asset. And that's going to ripple through. Oh, the rate of return is changing. Let's make it real. The IORB, let's say, goes up. If the IORB, interest on reserve balances, the interest the Fed pays banks on their reserve balances goes up, the rate of return of cash held at the Fed goes up, right? Well, that's going to impact all those things I just said. Money market and short-term bonds, long-term bonds, this thing called the federal funds rate, which is the rate banks get when they lend money to other banks. All of that is going to have to change. Now, let's kind of take a specific example for a second, okay? Let's just talk about bonds, okay? So remember, the IORB went up, the return on cash held at the Fed goes up, so bonds are going to be impacted because they're a substitute. There's something else a bank could invest into. So here's an existing bond. It's got a face value, $1,000, and a coupon rate of 10%, okay? Both of those things are printed on the bond. So important for students to understand that, okay? Now you just take your face value times your coupon rate and you get the cash return of the bond, the fixed income, the income this bond is going to pay. Well, 10% of $1,000 is $100. Now, that again is set in ink. That's been inked. That's permanent, right? These things are printed on the bond. This thing is not going to change. Whoever holds this bond is going to get $100 in a cash return. Now, what I need is for the rate of return of this bond to change. Why is the rate of return going to change? Because again, the rate of return on cash held at the Fed, right, that interest on reserve balances went up, right? The rate of return at cash held at the Fed went up. Well, that's going to impact this. That means the rate of return of this has to go up. Bond price. What's going to happen? Well, if the bond price is not printed on the bond, right, the bond price can change. Now, the return's not going to change. So how do I change the rate of return if the return doesn't change? The $100 is fixed. It's not going to change. It's the obligation of the person who issued this bond. Well, the bond price has to change. Again, I need the rate of return of this bond to go up. So what's going to happen? The bond price is going to go down. That's right. If the bond price goes down and it continues to pay a $100 return, the rate of return of the bond is going to go up. And again, why is the rate of return of the bond going to go up? Because it needs to stay competitive with other ways banks can allocate their assets, okay? Now, banks, when they allocate their assets, right, their asset allocation, well, that impacts assets that we investors also buy. We also buy bonds, so it's affecting bonds for us. So again, when they change interest rates, again, I have the Fed raising interest rates, bond prices are going to go down, and the rate of return of bonds is going to go up, okay? That confuses some students, but again, go back to what I said up here, okay? So again, bond prices, when the interest rates go up, are going to go down for what I said right here. And when those bond prices go down, again, the return isn't changing, so the rate of return is going up. And again, they have to stay competitive with the other ways banks can allocate their assets. Well, that's going to ripple through because of the substitutability of these wealth assets, right? Okay, so the rate of return of bonds is going up. Well, now the rate of return of stocks needs to go up. Well, how do we get the rate of return of stocks to go up? This is where it gets a little bit confusing. To get the rate of return of stocks to go up, the stock price must also fall, right? Stocks can pay dividends, right? The value of the stock is based on, an estimation of all future cash flows of that stock, right? So stock prices drop. Guess what? Their rate of return is increasing. That's a little bit confusing for students, but again, watch the video twice, okay? This is what we're trying to get our head around, right? Stock price goes down, their rate of return goes up. Real estate prices go down, their rate of return goes up. Let me talk about real estate because that one is very simple for some students, okay? So rents haven't changed. The amount that you can rent out a property hasn't changed, right? But it's just the rate of return of the real estate has to go up. Again, why? Because other assets rates of return have gone up. Well, if the rents that you can get when you rent out a home don't change, right? The dollar amount, the dollar return, that's the rental amount, right? If that's not changing, how do I get the rate of return of houses to go up? Well, house values must fall. If we raise interest rates, guys, bond prices are going to go down. Stock prices are going to go down. Real estate prices are going to go down because the rate of return of all these assets must go up. Because when the Fed raises interest rates, they are absolutely raising the rate of return of specific assets. And that is going to ripple through other assets in our economy because they are substitutable, okay? Everything in valuation gets back to interest rates. When the Fed changes interest rates, they know they're changing the prices of assets throughout our economy. Hope that made sense to you. It was my best shot at just getting a big picture of this. We can get into kind of specific things like how it changes the discount rate of assets. It's really kind of the same concept, just a little bit more mathy. And we can also get into other channels by which the interest rate affects these asset prices, such as changing the economic growth potential of the economy. But guys, I'm just trying to get that big picture thing. Hey, the Fed comes out, says something about interest rates that's a little bit different than what we were expecting, and immediately the stock market changes, right? The stock market raises or falls based on what the Fed says, and that is because of what we just talked about in this video. Hope that makes sense to you. Hope to see you in the next video.